Okay, so thanks for everybody for joining us today. We're going to be talking about reverse mortgages. I'm Laurie Knudson. I've been a realtor for 30 plus years, and laurieknudson.com is my website. With me today from Fairway Mortgage is Dominic DesMarais. Am I saying that correct?
Close enough. Can be said different ways. If it's the French pronunciation is DesMarais, the American presentation DesMarais is good. So either way, we're good. So
Knudson is the same way. I get Knudson all the time. So, and we will probably have people join us. Otherwise, we do have fellow agent on board here, Fred Schramm, and he's from Bridge Realty. And we're all here just to educate ourselves and the public about reverse mortgages. And you are the expert, Dom. So I'm really going to throw it over to you for the most part. If you want to get your screen ready to share, we'll get right into it.
Absolutely. And I'm going to have a lot of fun today. I hope everybody else has fun. I definitely will. Laurie, you seeing my screen?
Yes, I am.
Fantastic. I always like to check because even though I do this all the time, which literally I am on Zoom all the time, every once in a while, technology throws me an oddball, right?
Yes.
So first of all, we're helping a lot of people with, and you see on the screen here, it's called the home equity conversion mortgage. And Laurie had brought up reverse mortgages. Now, the home equity conversion mortgage is a reverse mortgage, but not all reverse mortgages are home equity conversion mortgages.
Mm-hmm.
A home equity conversion mortgage is the federal government program. It's an FHA loan. That's what I'm going to be speaking about today. Now, there are other reverse mortgages. I offer other reverse mortgages, but this is the one we primarily use for purchase. That's why I'm focusing on that. But if you have questions, please reach out to Laurie or I. I'm happy to share more information. But if we were to talk about everything there is to talk about reverse mortgages, it'd probably be about 4 or 5 hours. Everyone else would be sleeping, and I'd be the last one awake. So we don't want that today. We want to have a little fun, right?
Right.
The first question I always have, and okay, there we go. What is your opinion of reverse mortgages, right? That's always a question I get. Now, believe it or not, in today's world, I get a lot of people whose first opinion is they're actually great. And families that have taken them out, that's usually what I get. Usually when I hear that they're great, someone in their family has had one, they have one personally, and they're like, this is a fantastic experience. Typically, when I don't have someone whose family has one or personally has one, I get this response. I've heard some bad things about them. I'm here to learn the facts. And I think either answer is perfectly fine. The one thing that a lot of people need to be aware of, if you are out using, I think there's something called Google search. Most of us are familiar with it. By the way, I tried to provide some humor throughout this presentation, so I hope I get a smile or two. But, if you do Google search, you're going to read out a lot of things. Well, in 2015, the program was changed. So if you are reading things on the web and you see it prior to 2015, that information's all dead. It's all history. So you got to find new information if you are looking. So I just want you to be aware of that. One of the questions is, are you 62 or older and concerned about market volatility, inflation, maybe outliving your savings, making monthly mortgage payments in retirement? Did you know 44% of people 62 or older are still making a mortgage payment? I don't know about you, but that actually concerns me a little bit, right? And by the way, we are speaking in 2023, so I know we're making a recording. So that 44% is accurate as of 2023. If you're seeing this at a later time, it might be different.
I was going to ask Dom, if you don't mind me breaking in. What was the case for percentages of mortgages prior, like in 20 years ago, for people of 62 and older?
I don't know 20 years ago. I know it's consistently went up. So okay. I'll give you one thing. I'll give you as an example. In 2019, the number was 40% of 62 or older making mortgage payments. It's went up 1% each year for the last 4 years, Laurie. I know that at one time, most people tried to be paid off at 62. Right. I know at one point that it was over 80%, but I can't tell you at the high point. I don't think it was ever zero. Okay, I'll put it that way. But it definitely was less than 20% at one point.
Okay.
So we are seeing a change in perception and mentality a little bit, right?
Mm-hmm.
and not being able to continue to live in your home in a safe, sustainable way, a reverse mortgage could be the solution. And many people who are 62 or older find that it is a great solution for them. So now we talk about what is a home equity conversion mortgage, right? It's a loan program launched in 1989. This was actually created under the Reagan administration. It did roll out after he was no longer president, but it was created under the Reagan administration. It was the Obama administration who redid it in 2015. Now, you might say, why do I bring that up? My point is that both parties are a proponent of this program. And, you know, if I can have a little humor again, in today's world, anytime both parties agree on anything, I think it's a landmark, okay?
Yay, yes, that's true.
And again, little humor along the way, right? But we got, you know, the many amendments are improving consumer protections. It is the most used reverse mortgage in the United States. It's the only reverse mortgage insured by the Federal Housing Administration. And I just want to point that out, that this is a government loan, because sometimes when I go into some aspects of this, people will say, Dom, it doesn't seem like it's common sense. Well, there's a lot of government programs that are not common sense. And that's, I do want to point that out. So if you listen to some of the things I'm going through here today, or we're chatting with Laurie later or me later, and you say, what? Yeah, that's right. It's a government program. Just keep that in mind. So it is exclusively for those 62 or older. Now, there are reverse mortgages out there that go down to 55. That is not the HECEM program, but if you hear that, that is absolutely true. So I don't want you to think, what didn't this guy know his products? No, I actually do, but we're talking about the HECEM today. So reverse mortgages, pros and cons. It can be a great source of cash flow. It can have no monthly mortgage payments. Now, you still always need to pay your real estate taxes and homeowners insurance on your property. Okay, that is something that's always there. It's a non-recourse loan. It's fantastic that way. That means that the loan cannot follow you to a care center. It cannot be inherited by your heirs. It's a great program that way. And again, it's government insured. Okay, the cons, there is a minimum age requirement. If you are a married couple, one of you need to be 62. And every state except the state of Texas. In the state of Texas, both of you need to be 62. I only say this again because this is a recording. It might be a national recording. So if you are in Texas watching this, bad news. You're married, both of you need to be 62.
Well, I'm glad you said that, because I do have a friend who's in Texas who will be watching this later. So,
well, Laurie, that I'm trying to make sure that the recording is accurate as I possibly can.
There we go.
How about that, right?
Yes, thank you.
So, but otherwise, only one party of the couple needs to be 62. If you're cohabitating and you both want to be on the mortgage, then you both do need to be 62. However, if you're married and you're 65 and you have a 40-year-old spouse, that's perfectly okay. That is no problem at all. So I just want you to be aware. As a matter of fact, that 40-year-old spouse would have the opportunity to live in that home till they were 150 years of age. That's 150. So you could give them a place to live for 110 years. So just keep that in mind. Interest and fees do chip away at home equity because you are spending the savings account called home equity, and it must be your primary residence. So keep that in mind. If you have multiple homes, we have to put this on the primary residence. If you're buying, it's got to be your primary residence. Now, I'm not going to get too deep in this today because I want to be respectful of time. But keep in mind, if you are buying a cabin, a second home, a condo somewhere else, and you have a paid off home, you should still call Laurie or me and say, hey, I want to buy this. How do I do this? What we do is we put a HECM on your primary wherever you live, take the money out of that equity and go pay for that condo, cabin, or second home, maybe for cash. So there's still opportunities there. I don't want you to think there's no opportunities. Now, there's some myths with the reverse mortgage. One is the bank will own your home. Fact, you own the home and remain on title as long as you meet the loan terms. You are not giving the title over to the bank. I've had clients where I've explained that 5 times throughout the process. We're sitting at the closing table, and I'll have one of them say, now, when do we turn over title? You never turn over title. You own the home. Over 50% of the homes that we finance are in a trust even. So a trust is no problem in most cases. Now, another myth is your heirs will be stuck with a big bill. You or your heirs will never owe more than the value of the home after the loan matures and the home is sold. Okay. Even if 2008 happens again and your home drops in value, it doesn't matter. This is a federal government loan, and the federal government picks up the difference between what you owe and what the value of the home is if you are upside down. Now, for about 7 years, from about 2008 to approximately 2015, the FHA did pay out on most of those mortgages. So this is another guarantee if you're concerned about home values at all. So just keep that in mind. And I'm happy to go into that deeper with you. There's a lot more to be talked about there, but just be aware you never have to worry about that.
Just quick insertion here. Are you going to talk more about, like, say they're there for 10 years and they have a change of mind and they want to go maybe do this reverse mortgage on a different house? Will you be getting to that?
I absolutely will, Laurie. Actually, we're going to talk about maturity. And when I say about maturity, I don't mean your or my maturity. I don't know how we are with that.
Don't go with my maturity. Okay.
Exactly. We got problems there, right?
Yes. So we'll wait for you to get to that. Okay, sounds good.
But towards the end, I am going to talk about the maturity of the loan, what happens at the end, okay?
All right, thank you.
So we are going to get into that a little bit more. But Laurie, great question. I appreciate you asking that. Thank you. So now let's talk about why people are moving in retirement. Do you have a question, Laurie?
Nope, I just brought in
Erica.
Somebody else joined our group. Yep, Erica.
Fantastic. You know, here's why we typically see people moving for retirement. And by the way, I'm going to joke around a moment. You know, Laurie makes me feel like a kid with how many years she's been in the industry. I've only been in the industry 26 years. So, you know, I'm sort of new to the industry, right, compared to Laurie. But the you know, I joke around because when I started in 97, what happened is the adult children moved back to live next to the parents when they had their grandchild, right? Now, somewhere I want to say, and Laurie can chip in on this too, somewhere around, I'm saying 2010 to 2015, somewhere in that range, it became the opposite. The grandparents, if they want to see the grandkids now, they need to move wherever the adult children live. So something that I'm seeing a lot of is the grandparents being like, we want to be in our grandchildren's lives, so we're going to move closer to the family. That's a big one. Something I've seen a lot of, especially the last couple of years, wanting to reduce home expenses. You know, it has not gotten less expensive to have a home. It's gotten more expensive. Some of the real estate taxes are jumping significantly. Homeowners insurance in many parts of the country are jumping significantly. This is being recorded here in Minnesota. So if you are in Minnesota listening to this, you know your homeowners insurance, you're probably getting a little bit of, oh, what happened here? So that's definitely occurring. Change in health status. That's a big one too. By the way, in the last 12 months, and again, I'm speaking to you here in October 23 today. The last 12 months, I've had 2 couples that were in the middle of selling and buying again. And unfortunately, in those 2 cases, and by the way, I've had dozens of clients close well and everything, no problem. But in these 2 cases, the husbands fell downstairs. And in both cases, unfortunately, the husbands are no longer with us within the next 90 days. About a third of people who die after 62, falling down is what starts the decline. And sometimes, you know, they hit their head, sometimes there's broken bones, whatever it might be, but that actually starts the decline of them not being with us. So to me, the health status is a big one. It's what I'm passionate about. Change in marital status. You know, now it's funny. You know, I had 2 women at my presentation yesterday who both were joking around about how they would like to get divorced in their 70s. So unfortunately, you know, change in marital status, the fastest percentage growing divorce rate is in the silver and gray markets, right? So in the retired markets, so just be aware of that. Empty nesting, children moving out, wanting to cash from the sale of prior home. So, I mean, those are all things that I see for people moving in retirement. Can reverse mortgage be used to buy a home? Well, actually, that's why we're here today, right? We're here to talk about the Home Equity Conversion Mortgage for Purchase program. We call it for short H for P, HECEM for purchase. So anytime you see H for P on any of my slides after this, that's what it means. I just like to shorten things up if I can. You can upsize, downsize, right size into your ideal home. Move closer to the grandkids, put as little as 45 to 65% of the purchase price down from your funds, keep more of your retirement assets. There's no required monthly mortgage payments. You do have to pay property charges like taxes and insurance. And you're going to continue to see me saying the same thing over and over. By the end, you're probably going to take away a couple things. You always own the home. There's no mortgage payment required. You have to pay your property tax. You have to pay your homeowner's insurance. If you walk away with that, you already got a great start. Yes, Laurie.
So I wanted to jump in on that because a lot of people will say, oh my gosh, we have to put a little more than half down. And of course, we know there's going to be some variances and that you'll get to that. But I want to point out that most people want to go in to a retirement situation with no house payment. Well, in order to do it any other way, it means 100% of the price needs to be put down. So this is just one or more of the benefits, in my opinion. So.
Yep. And a little later in my presentation, I'm going to show 3 different ways of financing a home. And we're going to talk about the 3 options and the good and the bad of each, right? So we will, Laurie, you're doing a great preview. I appreciate that. So
I'm stealing all your thunder. Sorry.
But here's the H for P loan advantages we're going to talk about. Oh my goodness, we're going to talk about 3 ways to pay for the home. How about that? So,
how about that?
The first one is putting 20% down. And, that would be, and I'm using a 600,000 purchase example in today's environment. The funny thing is, in today's world, 600,000 is not a crazy number anymore. If I was sitting here 4 years ago in 2019, I would say 600,000. That's above average home. Now I'd say it's in the middle of the market. 20% down is one way to do it. You put $120,000 down. Looking at a 7.22 interest rate. And today that's actually a great rate. As you watch this in the future, that may be high, that may be low, rates go all over. But 7.433 APR, right? The challenge is by the time you pay that in its entirety, that would be the 1.4 million you see there on screen. Well, the challenge with that's 1.4 million of money you weren't able to live on. That's 1.4 million a lifestyle you gave up, right? So that is significant. And you see that payment, $4,080 a month. Imagine you're giving up about $50,000 a year in lifestyle. And all you're doing is you're putting in an illiquid investment. And here's the thing where I like to sort of joke around a little bit. The truth is, most of us, if we get in a tragic accident today and we're no longer with us, tonight at midnight, our adult children, usually the first thing they're going to do after the life celebration is they're going to put our homes up for sale. Less than 0.5% of the time do they move into that home. So all we're doing is paying money into an illiquid investment that the kids are just looking at it as a cash, be able to take the cash and spend it. So why should we, as retired people, not spend that money instead? So that's just my view on that. The second option is cash purchase, 600 grand. Well, that's fantastic. But the problem is, again, we just tied up $600,000. That means less of a lifestyle, right? So that's a challenge. And then the third option is H for P. In this particular case, it's a 62-year-old. So they're putting $385,800 down. That gives them a loan of $214,200. But think about that. From putting that $600,000 in cash down to putting $385,800 down, that means you have $214,200 to do something else with. And here's what I believe, and work with a lot of my clients over the last 8 years I've been offering this, is a lot of them, they would rather create memories for their families than leave big inheritances. Because truthfully, by the time your adult children get in their 30s, 40s, they've probably created their lives, right? And what they're going to remember more than anything else is the memories that are created. And I will tell you, after 26 years of being in this business, I've had many clients that have received big inheritances. And if you ask them 2 to 3 years later where the money went, they remember maybe a car purchase, maybe they did one special trip, and the rest of it just sort of withered away. So why not take your grandchildren on a special trip? Why not spend time with your kids? I've had clients use the HECEM and go on trips to Hawaii, Europe, Australia, Disney World. Yeah, Disney World's in there. Can you believe the cost of Disney World these days? But anyways,
I do
yeah,
want to jump in on that again, though, if you don't mind.
sure.
I'm going to say things that maybe you would disagree with, but I'm more new to this reverse mortgage than you are. I'm going to be 62 in a couple of years, so we're looking at this carefully. I got two things to say. About 40 years ago, the creation of a 401k, is that about right? 40 years ago. Otherwise, people were
correct.
very,
Yeah, it was the 80s, I believe. You are
yep.
correct.
Otherwise, people were very dependent on pensions. And notice how they've moved away from pensions and now it's 401k. I want to put some money in 401k. Maybe that's where I'd put the extra 214, right? Is in a 40, maybe I'd put it in the market. But I'm a realtor, so I like to have my different eggs in different baskets. Okay. So I kind of like holding back and not putting the whole 600,000 down and leaving something else. That 214 sounds real good to me, to not have to risk in either markets, to be honest. I mean, what are you going to do with the 214? I don't know, maybe put it in a CD at the bank. I don't know, but I just like the idea of being able to spread some things around, and just noticing that 401k, like a little cash in the bank wouldn't be so bad to have, I think.
I'll give you one more statistic. We might run a hair long as we're getting a little more conversational, which I'm okay with, but I just want to be respectful too. But the one thing, a statistic that came out about a month ago, and this one actually shocked me, for even someone who works the retirement field heavily. I read 3 to 5 economic articles a day, but when I read this economic report, I was a little shocked by it. 18% of people 62 or older in the United States. Now that's people. So keep in mind, if there's 2 people in a household, it'd be double that, right? So it's individual people. But 18% have investments outside real estate of $100,000, more than $100,000.
That's
So if
only
you look at that, right? So 82% have less than $100,000. So for that 82%, this 214 we're talking about, that would actually, plus the 100 they may have, that takes it to 314. It triples the amount of cash they have on hand as a reserve or as to be able to spend. So that's 82% of people. Again, couples that mixes those numbers a little bit. I just want to be clear about that. But keep that in mind. That's an incredible statistic. So Laurie, that just backs up what you're saying.
Yeah, that's just a win for me, because that's why the federal government has both sides parties, or all 3 or 4 parties agreeing on this, is we want to make sure that our seniors are able to manage, right? So I'll let you go back to your screen. Thanks for clarifying that.
No, absolutely. And again, I got a lot of stats that I've got. If we chat, I'm happy to chat with even more and explain some of these things. So a lot of people say, well, what's my purchasing power? Well, at age 62 right now, and by the way, this does change, based on what the interest rates are doing. So interest rates go down, the down payment goes down a little bit, but you don't want to wait, because here's what is now being forecast in October 2023 again by the Mortgage Bankers Association, and also David Stevens, who's the former head of the FHFA under Obama, and his team of economists that do consulting. They all believe that rates in about 14 months are going to be somewhere for a 30-year fixed between 5.9 and 6.2. And you might say, well, why wouldn't I just wait till then? Because the problem is there's going to be a whole bunch of new buyers and new demand. And a house at 600,000 now, it would not shock me to be 660,000 when that happens. So you want to get ahead of that. And keep in mind, there is something called a HECEM to HECM refinance, which we can get you actually more access to more equity. You might be able to put more money in your pocket. We can do a whole bunch of fun things down the road. But to me, you want to take advantage of the home prices while they're still where they're at, because it is going to go. Yeah, it is going to go up.
Date the rate, marry the house, right?
That is correct. But age 62 right now, it's about 65% down payment. Age 72, 60%. Age 82, 50%. And again, I do want to stress this is October 2023. So if you're seeing this months or years later, it's very possibly different then. Now, one thing you can do is you can downsize. I'm going to give you an example here. Cindy's 70. She's selling her current home, which she owns free and clear. She wants to live closer to her grandchildren. She wants to downsize, but she also would like to set up an annuity for her grandchildren. You know, she'd like the grandkids to have something when they go to college. And, you know, something to always think about when it comes to your home equity. That is, at the end of the day, if you have home equity when you die, that is going to be inheritance, right? But the question is, do you want that home equity given with a living hand or a dead hand, or a cold hand, you know? And what I mean by that is you could take the home equity out now and create that annuity, help those kids with that college education. I even encourage grandparents, if you got their grandkids and they're trying to buy that first home and they're struggling for that down payment, this is a fantastic way to take some money out of your equity, which is going to be inheritance anyhow, help them get into that first home and start building net worth and wealth. Because most Americans, if your income is below $172,000 a year, you have more money in equity than you do in investments. That's the average person. So, you know, her community is more expensive than her current one. A reverse mortgage is going to allow her to purchase a home in the new community and be able to have money left over from the sale of her current home. So what, you know, keep that in mind. What that looks like, she sells her $400,000 home. She buys one for $375,000. She puts $224,700 down, and she has $175,300 to spend on her grandchildren's annuity for their college education. That's going to mean so much more to those children than waiting till they're in their 30s and 40s and getting a check because grandma's no longer here, right?
Right.
Big difference. Makes sense, Laurie?
Right. And it gives the grandparent that joy. Like, they're alive here right now, and watching those kids grow up, she or he are going to have that in the back of their mind, and I just think doubles down the joy. I don't know how else to say it.
And imagine the stress it takes off the grandkids. I mean, look at how many people are stressing out paying their student loans right now, right? This helps take that stress off. So I think there's just so many things a grandparent can do in this situation. So, and the next one is upsizing. James and Mary are both 64. They want to move to a newly constructed home to retire. This is happening a lot right now. Single level living. They're selling their home. Typically the teenage home, which was the largest home, but also had stairs, everything. And they want to get to a nice single level home. Maybe one that, hey, you know what, we can lock the door. It's an association, and we can go to Florida or Arizona or Texas or Georgia or South Carolina, Tennessee, all the states that are attracting people right now for 3 months, 4 months, and then come back and we don't have to worry about it, right? Their home values in their desired community are almost twice as much as their current area. A realtor recommended a home equity conversion mortgage so they could afford the new home in the community. And what that looks like, they could continue to live in this home, $373,600. Instead, they sell, they clear the $373,600, and they go purchase a home for $600,000. And they have no monthly mortgage payments. Notice, see, it's a one level. Could very easily be in an association, so they no longer have to worry about lawn mowing expense, snow removal expense, trimming the trees, concrete driveways, patios, all those fun expenses. Because actually, when you start looking at home maintenance, the cost is dramatic. And most of my clients that end up selling and buying again, we actually lower their monthly expenses when you actually add it all up. And we do that budgeting piece. It's a lot of fun. Now, they still might have, of course, the homeowners insurance, the real estate taxes, any homeowners association, if that's there, and any other maintenance that would be there. So just so you're aware of that. So the basics for the home equity conversion mortgage, you do need to be 62 or older. And again, there's the tax exception, which I talked about earlier. It does need to be an FHA qualified home. You must live in the home for more than 6 months a year. So it does have to be your owner occupied place. Now, when I say live in the house more than 6 months a year, if you're out touring the country for 2 months of the year, well, that's still your primary residence, okay? Because I get asked that question. Well, what if you're not living anywhere else? Okay, maybe you're living in an RV, but you know what I mean. I mean, realistically, that's still your primary home. So optional monthly mortgage payment, never need to make a mortgage payment. Now, as of 2015, there are income requirements. If you look up on the internet, you're going to see no income requirements. That's prior to 2015, and it's now income-based. And that's why it is critical. If you are a couple where the wife worked part-time or maybe worked, full-time, but worked a little less wages so she could, maybe be more involved with the family, which is true of a lot of baby boomer couples, it is critical to do something before something happens to the husband. But every 6 to 8 weeks, I still have to tell a wife that they don't qualify, even though they have a paid off house that they're selling. It doesn't matter. This is not asset-based. This is income-based. And I know I'm sounding passionate. I am
I know, I
passionate.
can hear from the passion in your voice that you've had to go over that with people and the crushing news, because maybe that guy isn't retired, or so maybe he's 62 but still working. And that income, if he has anything happen that he is now incapacitated and can't work, it's going to be based on her income only.
And Laurie, part of my passion with this is the number one call. I hate talking to the wife because I have to give her a terrible news.
Yeah.
She's caught. And she wouldn't have had to have been.
Right.
And that's why it is so critical that we not be, well, I don't know if I want to bring this up to people I know. No, we want to help people. We got to bring it up sooner versus later. So
got it.
Number one misperception: you give up ownership of the home. You keep title of the home always. It does not require repayment until the last borrower permanently moves out of the home. Now that can be through either selling the home, it can be through, death. It can be through, whatever the case may be, right? Maybe moving to a care center. Never owe more than the house is worth, non-recourse. I talked about that earlier. So just, again, I know some of this seems like I'm repeating it. The reason I'm repeating it, because to me, these are the concepts I want you to walk away with today. There's actually a reason why there's certain concepts I'm repeating at different aspects, because I want you to walk away with certain things. Eligible property types, 1 to 4 unit properties. Now, the reason I bring up the 1 to 4 unit properties, we have had a number of people across the country that all of a sudden have a paid off house and they are starved for income. Well, to me, this is a great time then to sell that home and buy a duplex, triplex, or quad. You'll have no mortgage payment on it, and you get to collect that rent payment and change your financial life.
Wow, that's huge. As somebody who owns a duplex and has owned a fourplex, that's huge.
Correct. And we can help so many people who are struggling right now and change their financial reality.
So maybe they didn't have an income, but boom, now they do.
Correct. We can use that income to qualify, Laurie. Back to your point.
Yeah, it's 75% of the rent typically.
That is correct.
Yeah. So, and then I do see manufactured homes. So please continue, because that's super interesting.
Yeah, manufactured homes, double wide, built after June 15th, 1976. By the way, if anybody wants to know what a double wide manufactured home on a river in Colorado worth, it's currently worth about $700 and some thousand. I just had a client buy one, and I was shocked at how much they're getting for them. So you never know. Placement, right? Condos must be FHA approved. Planned unit developments, townhouses, property held in a living trust, not available in Texas. I'm sorry, Texas is a different state. So leaving it at there.
They can't do it with the trust there. Okay.
No, not that type of trust.
Not a living trust. Okay.
Not a living trust. Correct. Okay. I just like to bring this up. And I know, as a client, you may say, do I care? Well, just good to know that some things that they are done on a traditional purchase can't be done here. There can be no credits from us. Realtors cannot make any credits. Sellers can pay the owner's title insurance and the home warranties. Fees required to be paid under state or local law, which means transfer taxes. If a home inspection is listed on the purchase contract, a copy of the home inspection must be provided. So there are a couple of things that are different. I just want you to be aware of that when your realtor maybe does this a little differently than maybe your realtor has in the past. I just want you to understand why. That it's about the loan program there. Benefits of buying with the H4P loan. A few ways a heck of a purchase loan could benefit your clients. You could purchase in a 55 plus community, increase purchasing power, flexibility, no monthly mortgage payments, moving closer to family, better weather, and more appropriate home. Purchase for a home 40 to 70% down. Close in as little as 17 days. Now, I want to talk about that. Okay. The rules change by state. Okay. If we are in Minnesota, you have to do counseling before we can do an application, which means that you cannot get a pre-approval letter without doing your FHA counseling, because all these loans, you do have to do FHA counseling.
Okay.
So just keep that in mind. Now, if we're talking Wisconsin or Iowa or South Dakota, and I'm licensed in all those states too, as well as some others, then it's different. So please talk to Laurie or I about where you're thinking about buying, and we'll guide you on that. But when I say close in as little as 17 days, that assumes your counseling's been completed and we have all your income docs. Then we can close as little as 17 days.
Gotcha.
Counseling, a lot of times in Minnesota, because you do have to use Minnesota counselors, it can be up to a 2-week wait. If you're doing Iowa, South Dakota, Wisconsin, Florida, Colorado, they can use national counselors, and usually it's a 1 or 2 day wait. So it does vary by state. I can't say specifically what it's going to be in a location where you live, but talk to myself or to your realtor
We'll need a one-on-one with them. Yep.
Yeah. I wish I could be more specific, Laurie, but it's really changes by state. So I'm trying to be as, accurate as I could be.
Yep.
Now, Laurie brought up loan maturity. So guess what? I got one little slide that says we're going into that now, right?
Yeah.
What happens to make the loan due and payable? You sell your home. Since you're on the home and have title of the home, you can sell the home at any point. I've had multiple people actually do HECEM refinances and then sell the home a few years later and do a purchase. I've even had clients use this for purchase, and then a few years later, after one of the couple has passed away, the other one decides to go live somewhere else and does a second purchase using the HECEM. So keep in mind, you can sell the home at any time. You just pay off the current mortgage, and you can use the equity that's left to go purchase another home if you want, or go do something else with it. That is your option. You can still transfer the title to someone else. Okay, but once you transfer the title to someone else, the loan is due and payable. The last surviving buyer moves out permanently, and it can be to move in with an adult child, can be moving somewhere else to a different home, and it could be a lot of different situations. Then obviously it does need to get paid off. Default on the loan terms. There's 2 ways to default on this loan: not pay your property taxes, not pay your homeowner's insurance. Okay, you do those 2 things, you're not going to default on this loan. Or the last surviving borrower passes away. So just be aware that those are things that can occur.
And then when that happens, if there is an extra 50,000 of equity at the home, the realtor maybe charges a fee, but the heirs get the leftover equity, correct?
Yep, and we're getting to that in just a moment here. I'm going to be going into that. So.
Sorry.
So how is the loan balance repaid? Well, the loan is not yet due, and keep in mind this loan matures at 150 years of age. Okay, so it's probably not getting that. The loan's not gonna. You're not gonna outlive this loan, right?
Right.
Borrower can pay as much or as little towards the loan balance each month as they wish. You can always make a payment if you want. Or borrower can make no monthly payments. And usually most clients do not make monthly payments unless they're doing it for federal income tax reasons. Because a lot of times I can save clients my best scenario has been $170,000 in federal income taxes. But that again is a separate discussion. So we'll have that offline if you want to know more about that. But there is that option. So now, when the loan is due and payable, loan is typically satisfied via the sale of the home. HECEMs are non-recourse loans. That means that the sale of the home will always satisfy the loan repayment obligation. Neither the borrower or the heirs will be personally liable for any balance deficiency. So if you are upside down, as we call it on the loan, it doesn't matter. The federal government picks that up. So there's really a few scenarios for the heirs. Is there any equity left? The question is going to be either yes or no. If it's yes, you can pay off or refinance the loan balance and keep the home. Or if you don't want to keep the home, then you sell the home and pocket any profit. So back to what Laurie was saying, you sell the home, you pay off the loan, and you split the equity. And that happens anytime if you pass away. Basically, your heirs sell the home you live in, they pay off the current mortgage, and they split the equity that's left. So there's no difference there. Now, there's no equity left. the heirs get an opportunity. I'm going to use a scenario here. I don't have it on screen, so I'm just going to speak to this for a moment. Let's say you owe $400,000 and the home value is $300,000, and one of the kids want to buy it. They go get a current appraised value. It's $300,000. They get to buy it for 95% of that. So they'd get to buy it for $285,000. The federal government would pick up everything between that 285 and the 400 owed. So that means the family just got $115,000 they never would have had otherwise if they did not have the HECEM.
Wow.
Fantastic program. Or the kids can decide, hey, we don't want this home. We're going to sign a deed in lieu of foreclosure, and we are going to call FHA and tell them to come pick up the keys.
Okay.
Okay, that's your other option. So it depends whether there's any equity left, what path you want to go.
Gotcha.
Okay, and actually I'm finishing about 3 minutes early, so how about that? That's fantastic. Of course, I did cut out a few stories that I normally tell, but I always never know how far we're going to go, right?
Well, I've got about 100 questions, so we're good.
Well, no, you know, I want to make this still entertaining.
Yeah.
So
Yeah.
you might, a lot of people say, who is Fairway? Well, we are an employee-owned mortgage company. We've been around 27 years. We're licensed in all 50 states. We got about 6,800 employees, and we got over 2,000 people like myself out working with clients, helping clients. Over 650 branches. I am the branch manager of the Edina, Minnesota branch. I am licensed in 8 states, but certainly we have people on the ground in all 50 states. So we are able to help you no matter where you're at. You know, in 2022, we did a little over 42 billion in originations. And we do finance, that's our own money that we finance with. Last year, we were the number 2 HECEM for purchase volume. So far this year, we've been number 1 for HECEM purchase volume. So we do a lot of HECEM purchase. We do a ton of it. Okay. Now, that being said, last year we were number 3 retail HECEM volume lender. So we do a lot of HECEMs and a lot of refinances in there too. And there's a lot of reasons to do refinances. You might use that to maybe even buy life insurance. You might be just paying off a mortgage, might be doing a home remodel. I know I'm doing one right now where the couple's remodeling it so they can live in it the rest of their lives. So there's a lot of things that can be used for. So just keep in mind, there's a lot of different scenarios there. And, but we do a lot of this. We are specialists in this. We do underwrite in-house, which is different than brokering a loan. If you're a realtor, you know what I'm talking about. Usually the last thing you want to hear is the loans being brokered. We are an in-house lender, including the HECEM. So that does make things a little different. Do you have a question there, Laurie? I saw you look like you did.
Well, I was just wanted to point out that in my experience, 30 years plus in the business, and probably Erica and Fred can speak to this too, or just put it in the chat. But I wouldn't want to try a reverse mortgage HECEM or any reverse mortgage with somebody who's, I mean, there's very few people who do these. So you right. need, as far as companies. And so you want to go to somebody who's in the top ranking, does 42 plus billion. Like I wouldn't even consider asking any other lender who doesn't touch these to you don't do that. You have to go to somebody who knows what they're doing. And as you've explained this program to me, and you said, Laurie, you're going to have to sit through this 4 or 5 times before you, I believe it. Like, there's no way I'm going to pretend to know what you know. This is just the tip of the iceberg for me. But I can't stress that enough for anybody watching this back. This will be out on YouTube, and we want to make sure people understand you got to go to somebody who does these for a living, like for regular, consistent.
And just, you know, talking to, and again, I don't want this to be about me today, but since Laurie is talking about experience, you know, number 3 HECEM retail lender in the nation, and I'm number 13 at Fairway. Okay. So in other words, I do a lot of these.
Right.
I help a lot of people. It's something I specialize in, and I really, really enjoy this because I feel like we're helping people, right? Mm-hmm. There's my information at the very end. We'll keep that on screen for a moment or two here, and then we'll pop that off, and we can go back to a little more face to face. Again, I've been doing this over 26 years. I'm passionate about it. I have a lot of fun with it. I don't use an alarm clock to get up in the morning because I'm excited to get to work with my clients. something that I do, which most people love, but I drive some people crazy. I read 3 to 5 economic articles the very first thing when I wake up every morning, because it's the one time of day that I have to myself before my family gets up and before the phone starts ringing. All those things occur every day. So, if you want to know what's going on in the markets and things like that, I'm always happy to share that. So I'm going to stop sharing my screen now. I'm happy to answer any questions we have and go from there. So Erica, Fred, Laurie, I'm happy to answer anything. And Laurie, to your point, I spend over 26 hours a year training on this product. So
Yeah.
I believe me, I could talk another 2 to 3 hours about all the nuances, right? But today
Very
we want
detailed.
Yeah.
Very, very detailed. I've taken the loan origination test. I failed the first time without studying. I had to do it because I worked for a mortgage company at the time. And the question I missed was one of them was, how long do you have to wait to retake the test? And I'm a realtor, so I answered 24 hours. Nope, it's 30 days. So over those 30 days, I finally studied and then I passed it. But that being said, because I've been a realtor for 30 years, we used to actually do the pre-qual 1992. We would ask for the pay stubs, all the bills, statements, and then we'd hand it to a lender. So we would do somewhat of a pre-qualification before handing it to a lender. So I know just enough to be dangerous, but what you do, Dom, is pretty much like another degree in college. Speaking of, I noticed that the company is based out of Wisconsin, and you say Wisconsin like a Wisconsin person. Have you spent time in Wisconsin, or do you just talk to them a lot? Because when you say Wisconsin, that's a Wisconsinite speaking.
Well, first of all, I've snowmobiled the whole state, first of all, I'll tell you that much. But also, just a couple of weeks ago, corporate in Madison had me out there, and I was actually training other reverse loan officers how to work with realtors. So I've been recognized as being one of the better ones who work with realtors and support realtors. Because my goal, and maybe I don't know if you can unmute Fred and Erica too, or maybe they can unmute themselves.
I'll unmute them. Mm-hmm.
But here's my thing. I have a lot of fun doing this. I'm having a blast. But my goal is to help people grow their businesses. Now, Fred and Eric, I don't think either of you had the chance. I actually do a separate training called listings training, and it's how to get more listings by at least having knowledge of this program. Because believe it or not, there are realtors right now that are doing about another 5 to 7 million in volume each year by knowing how to use this program to get listings. And so if you are looking for more listings right now and you're like, and does this guy know what he's talking about? Yes, I've helped a lot of realtors have success. And something another thing that I'm passionate about right now, and I've actually been out speaking in Iowa to realtors, South Dakota, Wisconsin, Minnesota. I don't want to see realtors leave this business. I don't want to see good realtors get out of the business, yet a lot of people are. And all you got to do is change your behaviors and go after this market, and it is wide open. And the great thing is, if you're sitting on a listing appointment having this conversation, you're not going to have competition because nobody knows this.
Right. I was going to just say, you and I tend to think a lot alike, but I asked you earlier on a previous day that we talked about doing this Zoom, how many percentages of the wealth advisors out there know about this program? You want to answer that again?
Well, here's the funny thing. So I am a platinum sponsor of the Minnesota Financial Planner Association. They have approximately 660, 670 realtors. I have 69 realtors that have sent me proposals here, in months past. And the funny thing is, only about 10% of that group really understands how to use this well, right? A lot of them, and I actually do continuing ed for certified financial planners, by the way. I'll be doing my continuing ed the first week in November. Now you might say, well, can realtors come to that? Well, they could, but I'll tell you that most realtors are like, oh no. But now I was down in Rochester doing a realtor presentation, and a financial advisor showed up, and the financial advisor left about 10 minutes in and said to the person giving it, like, this is pretty generic stuff, right? But I can get very deep on taxes and returns and all that. But most financial advisors don't get this. The financial advisors who do get this are referring about 6 clients a year to me.
Right. And I get it that the financial, not to put words in their mouth, but they want to invest your money. They don't necessarily. So I would think this would be a good thing for them because the client is going to put less money down in that house in order to not get a payment. So I hope that we can bring some joy to their world as well. But I know for Fred and I, we are looking at gathering up groups, and probably Erica too. She's muted still because I think she has maybe noise in the background, but we want to help these customers who maybe want to go to that single level living patio style home. So it blows my mind. Fred, do you have anything you want to contribute about that?
No, it's an excellent presentation. I really appreciate it. It was a good learning experience.
Great. Yep. Erica says she's in, but the kids are loud. So Erica, you can just chat any questions you might have. But Fred, could you see this where, okay, let's just put it out there. Laurie, me, is buying a double wide in Florida. So it's interesting you should say that. I'm not 62 yet. And I don't know if it'll be my permanent residence there or not. But we definitely want to escape the winters in Minnesota. And I kind of, yeah, right. Like who wouldn't? I'm Laurie. I kind of go with the tagline, Laurie the Lake Lady. I sell now in northern Minnesota, the whole Brainerd to Walker area, maybe even north of Walker, kind of Park Rapids to Reamer. And so that includes like Gull Lake, Woman Lake, all those Great Lake chains and hundreds of other lakes in there. And that typically happens from May or April to about now in October. I have a showing after this Zoom. So I can do a lot from Florida and not be losing out on sales here. And but if my 1967 double wide gets wiped out by another Ian, which it happened to survive, and I close on it at the end of the month, but so it's in good shape, but it's good to know I could go get a brand new one and put it on that lot and do that reverse mortgage. So I just have to wait for like 4 more years of no hurricanes so I can be 62 and do that.
As long as it's your primary residence.
And by then I think we are going to make it the 6 months and a day that is required. So I do understand that it's got to be my primary residence to use the HECEM or reverse mortgage in general. But
if I can just throw one more thing in there. A lot of people say, how do they identify primary residence? So well, we aren't like the Minnesota Department of Revenue. Like Minnesota Department of Revenue will actually pull cell phone records to make sure what state you're in, right? We don't do that. Well, what we do to identify it is we're looking at the IRS, okay? So wherever you file taxes, we assume that's your primary residence. So the challenge is, if all of a sudden you're saying, hey, Florida's my primary residence, but you're filing Minnesota taxes, we got a challenge, right? And I've had this challenge with Arizona, Minnesota before, where people are like, well, Arizona's my primary residence. We still find Minnesota taxes. Well, Arizona is going to be well, we got to figure out how we're going to, be able to identify that and be able to prove that, right?
Yeah. And luckily I've got a couple years to figure that out. There are grandkids scenario here eventually too. But another thing I wanted to ask you about, and Fred, you jump in if you've got a question, Erica, you chat. What if we instead wanted to make it a condo on the beach? And again, I think you're going to say it's just as long as that's your permanent residence.
That is correct. As a matter of fact, I have financed. So the first half of last year, 40% of my business was in Florida. Now, right now it's crazy. I'm doing a lot of Colorado business. And Laurie, I don't know. Those are things I don't plan. It's sort of where I get referred. And right now, the Florida thing was actually driven a fair amount by realtors of referring clients, because it's another thing to keep in mind as a realtor. Someone buying in Florida, well, or they want to buy in Florida, but maybe they don't want to give up here or things, or maybe they can't get them to me. You pass them to a realtor, take the 25% referral fee, right? Because there's an opportunity for 25% referral fees here a lot. You're not going to someone who says, well, they can't afford it. Well, let's chat. Let them chat with me. Maybe there's an opportunity there, right? So then there's another opportunity. But in Colorado, it's been all driven by financial advisors. The financial advisors saying, hey, we got these clients out in Colorado. So I'm like, okay, no problem.
Education thing. And it's interesting. Both you and I are trainers for continuing education. I would like to start bringing groups in of retirees I'm very connected in Wisconsin, actually. My dad was a cop. And so I have relatives there, and I want to start pulling in the retirements, because some of them have settled in the area near I'm going to be. And I would like to start bringing them in some education, maybe at a happy hour kind of thing. Sharkies on the beach is a really great place to go to. But educate them. I love your approach. It happened to hit it off with us when we were talking the other day. I don't sell anybody anything. I'm the worst at selling. But I'm an educator about the process, and I'm happy to provide the route. I do make money, but
if I can throw out one thing here too, I have to take elder abuse classes every year, right?
Yes.
And part of elder abuse is you cannot push people into this. That doesn't mean we can't encourage. There's a difference. Now, if the FHA counselor, one question they're going to ask our clients when they're doing the counseling is, anyone coercing you into doing this? Your children, your realtor, your financial advisor, your mortgage person. And if they answer yes, we got a problem, right? Now, I've been doing this 8 years, never had that problem. I did have twice where adult children called me with conversations. Oh, excuse me, I'm sorry, I thought I had that
option. We want to explain in the option and then let them choose, right?
Correct. But twice I was going to say I have had to report elder abuse, unfortunately, in that 8 years, where the children were looking for the money from the parents' home. Right. And that is elder abuse by definition. So
absolutely. I'm a senior real estate specialist, so I get that. I don't think I have to take the elder abuse class, but I understand it completely, and it's a real thing. Sadly, in most of America, it's the Leave It to Beaver families, and they don't talk about finances. Correct. And so then the person might become vulnerable, and it's kind of getting slammed on them. So but getting up into that range of age, I want to be able to speak so knowledgeably about this and share. And I'm so glad you do business in Florida, because I will be that referral agent working with the agent. I already connected with one or two of them down in Florida, but plan to still bring this to education. And I mean, to even put the component in there of the up to fourplex provides a route. Now, I know a lot of people, that's a whole separate argument about maintaining and managing that, but there are services available. And if you can arrange all that, so then what if they are in Minnesota in a fourplex, but they still duck out to Florida for 3 months and just become that snowbird? I mean, this is a great option. It is over a lot of people's heads. So I know today you just did kind of the broad view, because as you said, and I'll just say it again, I think there's a lot of levers to pull depending on if this, then that. And so each person or couple has to have kind of a customized view analysis given by you, correct? I mean,
that is correct. So let me tell you that typically what I recommend is steps. And Eric and Fred, for you, I'm throwing in, and I had on screen too, I'm throwing in my email and my phone number. So if you wanted to attend one of my listings, trainings, it's there and available. I'm also doing in mid-December, I'm doing an AI training of how to put artificial intelligence in our businesses too. So I do a number of trainings. I just had a family law attorney in for cohabitation. I'm a big believer on educating. So just so you know, so that I threw that out. So sorry, Laurie, what was the point you were questioning about again?
Well, just that you and I do a lot through training. We don't push. Yeah. We're just we're contributing. Like, okay, so if I can't help you, then you should move on to somebody else, is always what I would say. And I have a very good rating out there in the world. I also don't take on such a huge team. I mean, Erica and company, it's a very small little boutique real estate brokerage that we're at Legacy Home Group. We work to support each other, but I don't have to support like 4 buyer agents. I am my own team, and then they assist me when needed if I need a showing help or whatever, which when I'm in Florida, they do. And that's important because I want that personal touch. How about you, Dom?
Yeah, I absolutely agree. Well, first of all, I'm all about the education, right? So typically when someone comes to any of my trainings, what I do is I pass around a sheet at the very end, said, if you want follow-up, let me know, and I will follow up with you. Typically, here's how I recommend this work. First of all, get enough information that you have the scripting, because in the listings training, I actually give you scripting. I actually give you a whole bunch of tools to actually use. And just so you're aware. But then from there, call me with the client's age, what we think their current home value is, and what they may be looking at. And we can either do a face-to-face or a Zoom meeting, or with using some software I have that actually shows what it could look like. Then if it seems to make sense, we do a meeting with the client. Now, some realtors at that point like to drop out. My recommendation is, if this is your first time going through, having a client go through it, ask the client if you can participate throughout the whole process. That's my recommendation. I've never seen a client say no. I have seen a couple times where clients have been like, when we discuss financials, that's where we don't want that. Okay, that's fine. I mean, there's certain aspects that maybe they don't want, but I do recommend being through it. Then we sit down with the client. And if the client says, yeah, this seems to make a lot of sense, then we start talking about the steps like getting counseling, actually, getting financial documents. And all of you know what it's like with mortgage. We need information, right? Sometimes we need less information with this loan, depending on what else is going on. Like if they're taking a big amount of money out of their home and for down payment on the next one, and they're not going to use it all, I may not even need asset statements, right? I may be able to just get social security letters, the driver's licenses, just basic information. Sometimes I need a lot of information. So it depends, right? It always is with mortgage. It depends on the client and what we need. But those are typically the next steps. But I do firmly believe, as realtors should attend the listings, because I'm actually going to give you tools that you can go get business today. And I'm going to give you one of those right now. Because so many people say to me, the number one objection I get from realtors is, I don't know anyone 62 or older that I could talk to about. And I say, do you talk to your past client base? And most realtors say yes. Some say no. That's a whole separate subject we won't get into today, okay? I have fun conversations with those people. But if you say, yes, I talk to my past client base. Okay, do you ask about their parents and grandparents? And now here I'm going to talk from being group presentations all over. There's two groups that do a horrendous job on this. One is the Twin Cities and one is Rochester. In Iowa, it don't matter where in Iowa. It don't matter if it's rural Iowa, Des Moines, Dubuque, Wisconsin, don't matter if it's Hudson or rural Wisconsin. Don't matter if it's Grand Rapids, Minnesota. Don't matter if it's Duluth, Minnesota, Sioux Falls, South Dakota. They all will ask about the parents. But in the Twin Cities and Rochester, for some reason, I get this feedback. Well, that makes me uncomfortable. They'll ask about the kids, but not about the parents. Start asking, how are the parents doing? And you might go, well, and then they're going to tell you. And maybe they give you enough information. Maybe they don't. Say, are they managing this? I know a lot of people I know are starting to struggle managing the stairs and stuff. How are they doing with that? Oh, they're doing great. And they're doing great financially. They're traveling everywhere.
They basically have the blinders on or their head in the sand.
Well, okay. They don't want to change their behaviors. And I don't get it because it's just a question. I mean, Laurie, if I ask you, and I don't know, I haven't asked this, so maybe your parents are gone already. I don't know if your parents are still alive. But if I ask you how your parents doing, that's not an offensive question, is it?
Not to me, but I can see where there would be some people that would be very challenged to want to answer that.
And it's only the Twin Cities and Rochester gives me that answer.
Isn't
Nowhere
that
else do realtors give me that answer. Nowhere else.
Dang Norwegians or something.
I don't know what it is. Because it's not rural Minnesota, not Iowa, not some. Only Twin City and Rochester realtors give me that answer, Laurie.
Yeah, and I get it that each senior is going to have their own, is this good for them or not? And I keep thinking of that 62-year-old couple where you had the picture of the gentleman and the young lady, elderly lady now, I guess we have to call them, and you said, I don't want to have to talk to the wife because what if something happens to him? So really at age 62 is an appropriate time to start asking about this. If it's a good time for you to think about this program, whether it's in your existing house and you just put it into a HECEM, or you move to that type of house that you'd like to have one level living, because those circumstances can change and it could be based on qualifications. And of course, it could be the reverse, right? It could be the guy who doesn't make as much as the woman, but.
Well, actually, financial advisors, we're usually starting to talk to them in their 50s because we need them at the right equity position in their 60s when they make that next move. And
right.
And here's how usually the conversations go of the realtors who are not Twin Cities and not Rochester. Erica, no problem. Thank you for attending. So, when you ask about the parents and they say, hey, yeah, my parents are starting to struggle physically with the stairs, say, you know, I got a guy that might be able to help them with a program, but, you know, I need an introduction to your parents where I could go visit them. Is that okay with you? Well, now it's
Right.
just a
So
list,
they have
not
to-
just a listing appointment. And if they say the parents are doing great physically and financially, you say, man, I'm so glad to hear that. They don't even know that you were asking them for about real estate. They don't even know because you never brought real estate up. You never brought mortgage up. You only bring it up if they say there's a problem, right? If there's a reason.
And that's the part that goes to my brain with some fear. And I lost my parents when they were very young, 50 and 51, roughly. So they've been gone a long time already now. So, but the fact is, so you are maybe 59 and your spouse is 63. Things are great right now. But what's it going to be in 10 years? You know, I don't think people are doing that thought process of maybe it's because they're not selfish enough, but they're not thinking about their future and how they should be in a comfortable, safe, secure position themselves.
Here's what I find the majority of the time, Laurie, it's not 100%, but most of the time, the wives are thinking about it and the husbands aren't.
Maybe that's it.
The wives are ready for the next step and men aren't. Hey, Fred, could you do me a favor? Could you email me from your email? I would be really appreciative. I'm not saying that I will write something down wrong or not type it in right, but if you could email me, then I can just hit respond and attach the PowerPoint presentation. If you'd be willing to do that, really be very appreciative. So
anything else that we need to cover, because we are almost getting out of time. I mean, you blew my mind with so many things that I'm so glad to know. And I don't know if it's going to be right for everybody. I kind of feel like it could be right for just about anybody. Is that a stretch?
Well, I believe, looking at statistics and looking at people's financial health, this is right for about 90% of retirees.
So I'm not wrong. It's really quite good. Okay.
Yeah. About 80% of my clients that I helped last year, that's 2022, had net worth between $500,000 and $4 million. So here's the mistake a lot of times realtors make. They're like, well, they don't need it. They can just pay cash. But you just committed them to paying tens of thousands of dollars of federal income taxes they wouldn't have paid otherwise. And to me, this should be part of your trust plan, of your retirement plan, whatever it looks like. This needs to be a component. I'm going to throw one last thing out to both of you, okay? When you're talking to someone, and I don't care what age they are, just ask them this question. And I have fun with financial advisors and I have fun with clients asking this question. What's your plan for your home equity? And then shut up and listen. And they're just going to stare at you in most cases. No one has thought about it. So,
right. So
when we ask that question, we get all of a sudden there is a gear that starts turning there. They didn't even know that gear existed, right? What do you mean by plan for my home equity? So
they haven't thought about it because I've asked that question and they haven't thought about it. And then they're going to, well, I suppose we'll need to sell. And then it comes to what are we going to buy? Which so much of this is answered by that program. So some of these people will tune in later. They know who they are, and I'll be sending this to them because they've been thinking about it. And I didn't want to ruin the stew, so to speak, by telling them some inaccurate information. So I waited for this session. But great way to end it is, what are your plans with your home equity?
Well, one thing I always want to say at the end of every time, Laurie and Fred, I know that many things you could have been doing this afternoon rather than listening to me. So I'm honored that both of you spent time with me today. I never take that for granted. Every single day, I know each of us have a lot of choice with our hours. So thank you for your time. I'm very appreciative. I certainly hope that we have Laurie, I'm sure you and I'll be having conversations. Fred, you don't know me yet. Hopefully we'll have conversations on the road too. And I just want to say I appreciate both of you. So
appreciate you giving up your time and knowledge. I mean, honestly, we should get you over to the Board of Realtors and have you do a class and that's a whole nother thing. To get a class approved is forever. But appreciate your time. I know I have a showing I got to go do. And if there's no other questions from you, Fred, I think we're going to just. All right.
Thank you so much.
Let's go help some people, y'all.